सर स्टार्ट करना है? ओके ठीक है. गुड इवनिंग स्टूडेंट्स, वेलकम बैक.
Good evening, sir.
Yeah, welcome to our evening classes LVC for CA final subject direct taxes and a very important, very interesting topic of income from capital gains. Now we have covered some very significant part of this chapter. So, and I expect that you have also parallelly been studying. So let me first take up questions, queries, whatever you have. And then after addressing your queries, questions, then we will move on to the further part where I expect to complete a major part of the provisions today. And then the balance in the last session that will happen day after. So yes, students, tell me, whatever you have studied in this topic, any particular issue, question, doubt, put it across to me. Yes, tell me. No doubt, students. Yes. Okay. So some important aspects. First, yeah, sorry. Now, let me take some important aspects as a revision so that it will pave way for the other things that are coming up today. So I have given you a golden rule first. So where any asset considered as transfer as per the list of not transfer, then two things. One, period of holding will be counted from the date of previous owner or the previous asset. And two, the cost of acquisition to you of this asset will be the cost to the previous owner or the cost of the previous asset against the exchange of which you have got this present asset. Similarly, the second golden rule which I gave to you, for which we are going to see more cases today, is that where at the time of receiving the asset, acquiring the asset, you had to pay tax. Normally, this doesn't happen, but let us say acquisition of the asset is regarded as income, maybe under salary, maybe under other sources. Like in case of ESOPs, when you receive the ESOP shares, it was considered as salary income. So at the time of receiving the shares, there is some amount which became payable as income tax. In such a case, what will be the cost of acquisition of such asset received at the time of receiving an asset? It is considered as income. It is considered taxable under any head, and generally it will happen in other sources or at times maybe under PGBP or salary. In such cases, what should be the cost of acquisition for you of that asset? The answer is the cost of acquisition would be the value which was taken of that asset for determining your income. So these are two important golden rules. Why they are golden rules? Because they will continue in multiple scenarios. Then, up till now, we have dealt with some important practical cases. So let me just revise those so that once these are repeated, that will be helpful to you. So, first important thing is daughter sold the building's date before that iconic date just to show you the impact of indexation. Now, firstly, if you remember, I'd explained you the logic of indexation. So the logic of indexation is that since your cost is of some earlier year where the money value, the inflation was different, if it is getting sold in the current year and you are receiving today's money value cannot be compared with the cost which is money value of old period. Hence, what we do is we try to bring the old cost from its old money value to the present money value. So in short, we inflate the old cost to the current inflation level. That is what is indexation. Now here, in this case, what we try to discuss in this practical scenario is, now we have already seen our golden rule that whenever you get the asset in one of the ways which is not transfer, like gift is not transfer. In such a case, for you, the cost is cost of previous owner. Now, here you have acquired the asset on 15 September 12, but the previous owner had acquired the asset in the year 4-5. Now, the question is, while indexing, you have to multiply by the year of sale indexation value, which will be 24-25, which is our year of transfer, and you divide it by the year in which the asset became the property of the assessee. Now here, as per the verbatim provision, you should divide it by the indexation value of 1213, that is the year in which it became the property of the assessee. But if you do that, it defeats the original logic of indexation, because indexation is to index the value from its original year to the present year. Now the original year of this is 4-5. Hence, here we have that Manjula Shah Honorable Mumbai High Court judgment, which says that you should divide it by the year in which the previous owner had purchased the asset. So you should divide it by 4-5 and not by the year in which you have acquired the asset. So there are two perspectives. So whenever you have the case where you have to take the cost of previous owner, you have to remember this case law of Honorable Bombay High Court in the case of, it says you have to divide it by the indexation value of the previous owner. However, verbatim, the provision of indexation requires you to divide it by the year in which you acquired the asset. Then, another practical scenario which we had discussed was a parallel section 45(2), which created a special situation where you are converting your capital asset into stock in trade. Now, when you are converting your capital asset into stock in trade, I'd explained you that actually you're not doing anything. The asset is still lying with you. Everything is same. The only thing is that there is a change in the classification in your books of accounts. So what appeared in your books of accounts as a capital asset is now shown under current asset. That is the only change. Now, I've taken an example to explain you the working part of this. So let us say you had purchased land on 1st of Jan 2006 as an investment. Investment means it should appear as a capital asset. Now the purchase price is 20 lakhs, stamp duty value is 22 lakhs. Now, on 1st Jan 2016, you decided to start a new business of dealing in land. So this land which was purchased and held by you as an investment, as a capital asset, is now shown as a stock in trade in this new business. Now there is no transfer. However, section 247 deems this conversion to be a transfer. Now for this, one, you have to check the FMV on this date. That is a date of conversion, which is now treated as transfer. And we also have a stamp duty value provision. However, since we are in this special scenario of 45.2, it says that you will take the FMV only. You will not consider the stamp duty value. So this is important to be noted that here we are not going to consider the stamp duty value. We are going to limit ourselves only to the value as provided in 45.2, that is the fair market value. Now, this asset is finally sold on 4 Jan 2025, where you get a sale price of 5.5 CR and there is a stamp duty value of 6.75 CR. So what does 45.2 says? The computation will happen in the year of actual sale. And in that year, since the sale is of SIT, there is PGBP income which is triggered, and the original capital gain on conversion is also taxed in this same year. For PGBP, the sale price as per section 43 CA, which I hope you all recall from PGBP chapter, is similar to what you study over here in capital gain chapter, that whenever land or building is transferred, you have to add 10% to the sale value. Now this comes to 6.05 CR. If stamp duty value is even higher, then the stamp duty value will be considered as your sale value. So sale value for the purpose of computing PGBP is the stamp duty value minus cost of acquisition is what? It is the same FMV which is considered as full value for computing capital gain. The same FMV becomes cost here. So logically, what was considered as income for computing conversion has to become cost for computing PGBP. So this is your PGBP income, and capital gain income will be computed as per the regular format. So full value minus index cost. Now for indexation, you divide it by the year of purchase inflation value, and you multiplied by the year of transfer inflation value. Now here what is to be noted is, we are taxing this transaction in the current year 24-25, but for indexing we multiplied by the year of transfers indexation value. So it is of 15-16, not of the current year 24-25. And then you get your capital gain, which will be taxed in the current year. Then I explained you the change which has happened from this year. The iconic date is 23rd of July 2024. If your asset is transferred before that, or if your asset is transferred after that, there is a very big change. There is a big difference in the computation. Now, for this, I have taken an example. Vishal Poddar, a resident individual, had purchased land in 8-9 for 20 lakhs and has sold this land. First option is 15 May, second option is 15th August 24. The value is 1 crore. Now here again, since it is sale of land, the stamp duty valuation of checking plus 10% applies, but we are ignoring just for simplicity because our focus is not on the sale value part. So first working where the asset is sold before that iconic date. So full value 1 CR, no expenses, so net consideration is 1 CR. Now here indexation is applicable compulsorily before 23rd of July. Now, in this case, you index it by our formula, multiplying by current year's indexation value, dividing that by the purchasing year's indexation value. So you get an index cost, and subtracting it, you get LTCG. Now, what has changed is, if the transfer has taken place after 23rd of July, then you have to compulsorily show the working in your computation of income without indexation. I repeat, you have to compulsorily show the computation of your income in the computation without indexing. So I do it. 1 CR net consideration, 20 lakhs original cost, so 80 lakhs LTCG. Now, if you are a resident individual, you are given an option that you can compute the tax either by the old method or the new method. Old method is with indexation, where the tax rate will be 20%, and the new method is without indexation, where the tax rate is 12.5%. In this case, only resident individual HUF are given this option that they can compute and take the tax whichever is lower. So up till computation of income, you can see my computation of income remains without indexation only. However, when I go to compute tax, I have two options. The income which is without indexation multiplied by 12.5%, I compute the tax liability which comes to 10 lakhs, or the income which is with indexation into 20%. And then I have to pay tax whichever is lower. So I will be paying tax of 9.4 lakhs. How? Here in my original computation, we have shown 80 lakhs. So my tax will be shown as 10 lakhs, or it is coming as 10 lakhs at the rate of 12.5%. But internally in the working note, you will reduce the tax and you will come to the tax whichever is lower. So effectively, when I'm computing tax, my tax liability on capital gain will be limited to 9.4 lakhs. This is what is the new scheme of computing capital gain long term. This applies to everyone. For everyone, without indexation only you have to compute, including for individual HUF. But in the computation of tax for resident individual HUF, you can take whichever is lower. Then we dealt with another practical case scenario where a non-resident has purchased shares or debentures of Indian company by making payment in foreign currency. Now, if this is satisfied, then first proviso to our computation section 48 applies. It says that you will compute the capital gain in dollars and then recompute the final capital gain into rupees. So all the values that we have is converted from rupee to dollar. Now for this, they ask you to take the average of telegraphic transfer buy and sell rate. So you have the rates given by the bank, which is called as PTBR, PTSR, telegraphic transfer buying rate, telegraphic transfer sell rate. This is for the date of purchase. This is for the date of transfer. So for converting full value and expenses, you take the average as on the date of transfer, that is today. But for converting cost of acquisition, since cost of acquisition deals with the old period, you will take the conversion rate, the average conversion rate of the year of purchase. So you compute the capital gain, which is originally now in dollars. Then that dollar capital gain is reconverted to rupee capital gain. But for reconversion, you only take one rate, which is the telegraphic transfer buy rate. So this is how first proviso computes capital gains. So these are the different practical case scenarios that we have dealt with. And then there are these different provisions that we dealt with. And in the last class, we were dealing with the provisions of cost of acquisition. Now in cost of acquisition, firstly, the general rule of cost of acquisition is it is the cost of purchase or construction plus all expenses up to the date the asset is first put to use. This is the general rule given in section Now you have special cases. First, if it is intangible assets, then you have to check whether you had purchased it or it is self-generated. If it is purchased, it is the cost of purchase. And in case after purchasing, you have capitalized it and you are claiming depreciation, then whatever is the depreciation claim has to be subtracted. If it is self-generated, it will be taken as nil. Second, if the asset is acquired before 1st April 2001, then what will be cost of acquisition for any other asset other than land building? It is simply higher of your actual cost and FMV on 1st April 2001. But in case of land building, it will be higher of cost of acquisition and FMV, but this FMV is subject to the stamp duty value on 1st April 21. So you'll compare actual cost with these two figures. You have to take the lower of these two figures, FMV and stamp duty value of 1st April 2001. And this figure will be compared with cost of acquisition and you will take whichever is higher. Then you have golden rule 1, where you take cost of previous owner. Then in case of rights and bonus shares, the cost is nil. In case of right shares, the cost is cost of purchase. So these are the different things that we studied up till now. Anybody, any questions or doubts? Yes, students. Anybody having any questions or doubts? Engage says no. I assume same for everyone else. So then let us proceed. So this is what we were dealing with. So this is the section 49(1), where your cost is to be taken as cost of previous owner. Why? Because it covers all the scenarios which are of not transfer. Similarly, there are other provisions also where share is received in case of amalgamation. Same rule, since it is not transfer, whatever new shares you have received, the cost of acquisition of new shares will be cost of acquisition of the old share which is exchange. Similarly, sorry, we have received share or debentures because of conversion of bonds or debentures. Again, this conversion is not transfer. So whatever is a new asset, that is a share or debenture received, the cost is cost of previous share. Then what if you have received sweat equity share? Here our golden rule number 2 applies. At the time of receiving this amount was taxed under the head salaries. Since it was taxed, now the cost of acquisition of these sweat equity shares in the hands of the employee would be the amount which was considered as income. And what is considered as income under the head salary? It is the fair market value of this asset. Next, again a case which is not transfer, that is where a private or an unlisted company is converted into LLP. What happens in the hands of the shareholder? The shareholder gives away the shares of the converted company, and in exchange, it gets the right to become partner of the LLP. What is the cost of this right? The cost of this right is the cost of acquisition of the shares. Then let me take something which is different and also important. Yes. Now we come to this case scenario, which is again the case scenario of what is not transfer. But here, small working is required. What is this case scenario? Shares received in the resulting company, that is a new company, in the case of demerger. So let me first take an example of this. So shares in new company after demerger. Now let us understand what has happened. You were shareholder of company A. Company A got split and one division of company A became company B and the other division continued as company A. Or another possibility is this whole company A is closed down and you get two companies, company B and C. Both these are examples of demerger. Now let us say you had acquired the share of company A for rupees 450 per share. Now after demerger, you are having two shares, one of company B, one of company A, if the same company is continuing with a smaller vertical, or a new another company C. Now in this case, the rule remains same, golden rule 1. What is the cost of acquisition of the new shares? Since this conversion from old to new is not transfer, the cost of acquisition of new share has to be cost of acquisition of old share. But now what is the catch? The catch is now you have two new shares, one of company B, one of company A. But you had only one share of old company. In this case, how to apply our golden rule 1? For this particular point is what we were having in front of our screens. So what it says, to find out the cost of acquisition of shares in company B, you have to take the shares of the old company. So the old company shares cost was 450 to you, multiplied by how much is the net worth which is transferred to company B out of the total net worth of company A before demerger. So let us say the net worth of company A was rupees 1000 crore. And the demerger has taken place like this. 600 crore of net worth has come here and 400 crore of net worth is retained by company A. So here I'll multiply this by 600 crore divided by 1000 crore. So I will get what should be the proportionate cost to me of one share of company B. Similarly, what will be the cost of acquisition of share in the other company, which is over here A, or it could be C. It will be 450 minus whatever cost you get here. So whatever cost you compute, that will be subtracted, and this will become the cost of the new share. I hope this is understood and clear by all. Yes, students?
Yes.
Anybody, any doubts, questions? No? Perfect. So here it is coming as 270. And when I subtract 270 from this, what I get is 180. So this is how the cost of acquisition is computed. So Sanjay, can you please read this for me?
Yes. Section 49(2)(c). Shares received in the resulting company in the scheme of demerger. In case of demerger, the cost of acquisition of the shares in the resulting company shall be the amount which bears to the cost of acquisition of shares held by the SSC in the demerged company in the same proportion as the net book value of the assets transferred in a demerger bears to the net worth of the demerged company immediately before such demerger.
So this is nothing but this. So cost of acquisition of old shares multiplied by net worth transfer upon total net worth before demerger. So this is what has been given in language form. So that is what they have explained here also. Please continue.
The cost of acquisition of shares in the resulting company is equal to A multiplied by B upon C. A is equal to cost of acquisition of shares held in the demerged company. B is equal to net book value of the assets transferred in a demerger. C is equal to net worth of the demerged company, that is, the aggregate of paid up share capital and general reserves as appearing in the books of the accounts of the demerged company immediately before the demerger.
Fine.
The
And then we
net,
know the meaning of net worth, right?
right.
Read this. This is for the second part. So the other company that is given here.
49.2d. Shares held in the demerged company. In case of demerger, the cost of acquisition of the original shares held by the shareholder in the demerged company shall be deemed to have been reduced by the amount as so arrived under subsection 2c. The
So
provisions
whatever
of
we calculated here in 2C, see this is 2C, that is this proportionate value that has to be reduced from the total cost of the share. So in my example, per share costed you 450 of the original company, and the proportionate value that you calculated for the demerged company was 270. So 450 minus 270 balance is the cost of the demerged company, that is the second company. Fine. Continue.
the provisions of section 49.2c and 49.2d also applies in relation to business reorganization of a cooperative bank as referred to in section 44db.
So whatever you computed here, the same thing will apply whenever there will be demerger of banks. So obviously no new provision required, the provision remains same. Now, this is a special case which I had left out earlier. So now let me take that special case. So when we were dealing with section 47, what is not transfer, in that case, there was a scenario where not transfer covered one case that was between holding to subsidiary, if you remember. Now, whenever there is transfer between holding to subsidiary and subsidiary to holding, it was not considered as a transfer. However, it had come with some condition restriction, and what if any of the condition restriction is not satisfied? That is what we are going to cover in section 47A. So let me first go back to that particular point. So this is the list of what is not transfer. If you remember, we had discussed this. Now in this, I'm talking about these two scenarios, clause 4 and clause 5. Please read.
Yeah, 47, clause 4, any transfer by a holding company to its subsidiary company, any capital asset, A, the parent company or its nominees must hold the whole of the shares of the subsidiary, and B, the subsidiary company must be an Indian company.
Continue.
47.5, any transfer by a subsidiary company to the holding company, any capital asset, A, the whole of the share capital of the subsidiary company must be held by the holding company, and B, the holding company must be an Indian company. The exemption mentioned in section 47.4 or 5 will not apply if a capital asset is transferred as stock in trade.
So for both these cases, holding to subsidiary or subsidiary to holding, it is not regarded as transfer subject to two main conditions. One, it is a 100% holding subsidiary. Second, the transferee should be an Indian company. Now with this is then important, you can say a rider, that this exemption will apply only if the asset which is transferred as an asset, or it is treated as an asset in the hands of the transferee company. If the transferor is transferring an asset, but the transferee is considering it as stock in trade, then this exemption under 47 will not apply. Now, what will happen in such a case? That is given in 47A. So what does 47A says? Provides for withdrawal of benefit of exemption given by 47 in certain cases. So 47 said certain transactions not regarded as transfer, so no capital gain applicable. However, there were some conditions. Now, what if any of these conditions are breached? Then 47A comes into picture and it says, now I will tax it. So here we are considering this first scenario, which is covered in 47A. Please read.
Section 47A provides for withdrawal of the benefit of exemption given by Section 47 in certain cases. Number one, conditions for transfer of capital asset by holding to its wholly owned subsidiary and vice versa. Section 47(4) or 47(5). As noted above, capital gains arising from the transfer of a capital asset by a company to its wholly owned subsidiary company is exempt from tax. Similarly, capital gains arising from the transfer of a capital asset by the subsidiary company to its 100% holding company is also exempt from tax, provided under circumstances the transferee is an Indian company. Section 47A provides that the above exemption will be withdrawn if at any time before the expiry of 8 years from the date of transfer of a capital asset referred to above. Number one, such capital asset is converted by the transferee company or is treated by it as stock in trade of its business, or two, the parent company or its nominee ceases to hold the whole of the share capital of the subsidiary company. In the above two cases, the amount of capital gains exempt from tax by virtue of provisions contained in Section 47 will be deemed to be the income of the transferor company chargeable under the head capital gains of the year in which such transfer took place.
Now, this is the very interesting part. So this part is what we just saw, the exemption, holding to subsidiary, subsidiary to holding, covered in these two clauses of 47. It is not transfer, subject to the condition that first it is 100% holding, and secondly the transfer is an Indian company. Fine. With that, there was a rider that it should not be transferred as stock in trade. Now, what does 47A says? 47A has put a time period. It has kept a time period of 8 years from the date of this transfer, that any of the following breach should not happen. One, the transferee company should not treat the capital asset received as a stock in trade of business. So this should not happen. Two, the 100% holding subsidiary relationship should continue. So they want that up to 8 years, both these conditions remain satisfied. Now, what will happen if in between 8 years, one of the conditions is breached? If in between 8 years, one of the conditions is breached, the effect would be simple. The exemption which was given earlier is withdrawn. So this is what is given. The amount of capital gain exempt from tax by virtue of the provisions contained in 47 will be, now this is the main part, deemed to be the income of the transferor. Obviously, capital gain is the income of the transferor, so it will be treated as income of the transferor. Tax under that capital gain, but when in the year in which transfer took place. Now, please understand this. See, workings are now easy. Once you have understood the basic format of capital gain working, all the workings are going to be same. But what is important is, today I'm in 24, 25, or let us say today I'm in 25, 26. This transfer had taken place in 23, 24, when all the above conditions were intact. However, in next 2.5, 3 years, one of the above condition was breached. Now, what this particular 47 says, if any of the condition is breached, what was exempt then, we will make it taxable today. But today means I will not consider it as income of this year, that is 25, 26. Today, I will recompute the income of the original year, that is the year in which the transfer had taken place. That is in my example 23, 24. So in this year, I will be filing two returns. One of the current year, this year means next year in the assessment year, I'll be filing return of the current year 25, 26, plus I will be showing recomputation of the year 23, 24. So this is the first scenario, what is covered in section 47. So what you have to understand is what was exempt earlier is made taxable. Now, 1 second. Okay, so so what you have to remember, two things. For continuity of this exemption, 8 years, no breach should have happened. Second, if the breach happens, whenever it happens, you will have to show the computation in the original year by recomputing that year's income in the current year. So these two things you will have to keep in mind. I hope this is clear and this will be in your minds, because see, at this level, we will be more asked question in terms of case studies or in terms of advice. So this particular part, 47 is very much asked from the advice point of view, that please guide. They will tell you the scenario and they will say, please guide what the company should do to ensure that the exemption is never withdrawn. So this is where this 47A will come into picture.
So
Fine.
in this case for 23-24, we have to revise the return.
No, that is why I use the word recompute, because see, revision has a time limit, right?
Yes,
You would be knowing that there is a time limit for revising the return.
yes,
Now that is after the due date is gone, it is end of your assessment year only, correct?
correct.
Now, very well between if this time limit is 8 years, your revision time would have gone. So that is why I'm using the word recomputation. So instead of revising, what you do is you call it as recomputation, because the act is requiring you to do it. See, revising is something which you do it because you found some mistake and you want to correct it, right? That is
Right,
where
yes,
the time limit comes in. Here you are not revising it. Here you are recomputing because the act is making you do it.
right. So this will be included in this year's return only 25-26 after recomputation.
Correct.
Right.
Fine.
Yes,
Now we go
fine.
to the other scenario which is covered in 47A. Oh, yes.
Transfer of membership of a recognized stock exchange for shares. Section 47(11). Capital gains not charged to tax under clause 11 of section 47 shall be deemed to be the income chargeable under the head capital gains of the previous year in which such transfer took place if the shares of the company received in exchange for transfer of membership in a recognized stock exchange are transferred at any time before the expiry of 3 years from the date of such transfer.
Correct. Now, this is the another scenario of not transfer. What is this scenario? Let us understand. The scenario is, again, this point is where the stock exchange, which was earlier AOP, is converted into stock exchange, which is company. Now, when this happens, if you remember, what is not transfer is that you had given, or you were the member, you were the stockbroker of the old stock exchange, holding the membership rights in the old stock exchange, which you have given, and in exchange, the new stock exchange gave you the shares. This transfer, this exchange was not regarded as transfer. Now, what they are simply saying is, in order that this benefit continues, they say that capital gain not charged in this clause shall be deemed to be income from capital gains of the previous year in which the transfer took place if the shares of the company received in exchange for transfer of membership is transferred at any time before 3 years. In other words, you should continue to be the stockbroker of this new stock exchange for next 3 years after this conversion has taken place. If between these 3 years you sell away your brokership or your shares in this new stock exchange, which gives you the right of trading to any other person, then the benefit which we had given you earlier at the time of conversion will be withdrawn. So here the condition is up to 3 years, you should not transfer your shares to any other person. Now, please read this.
Transfer of capital asset or intangible asset on succession of firm, sole proprietary concern by a company. Section 47(13) or 47(14). Were any of the conditions laid down in section 47(13) or 14, as the case may be for succession of a firm or sole proprietary concern by a company are not complied with, the amount of profits or gains arising from the transfer of such capital asset or intangible asset shall be deemed to be the profits and gains chargeable to tax of the successor company for the previous year in which the conditions are not complied with.
Now, here what is the scenario? This one and even the next one. Both these are the scenario where a business is, the constitution of business is changed. So earlier you were a partnership firm, now you are converted to company, or you were a sole proprietary, you are converted into company. Similarly, in second case scenario, you are a private company converted to LLP, or you are an unlisted public company converted to LLP. Now we have seen above that all these are again not regarded as transfer. They are not liable to tax. So whenever this conversion takes place, what happens is in your books of accounts, you would have done this in your accounting subject, maybe in foundation or inter somewhere, that the old firm which is getting closed is showing that it is selling all its assets liabilities to the company. The proprietor which is getting merged or converted into companies again showing that it is selling all its liabilities assets to the company. In such a case, whenever all these assets and liabilities are sold to the company, the new company, then there is no tax on such reconstitution of firm. Similarly, vice versa, where a company wants to convert to LLP. Again, for this reconstitution, what is shown in the books of the company is that the company transfers all its assets liabilities to the LLP. Now, in both cases, these clauses 47.13.14 and 47.13b, it is giving you the benefit of not considering this as a transfer, but with a condition that you should fulfill certain conditions which were laid down in these sections. Now, let me first give you what are these conditions so that just it will be a revision. Hmm. So, this was a table where this conversion has taken place either from partnership firm to company or from proprietary firm to company, and then these are the conditions which are given. So this is the condition where a sole proprietor is converted to a company. Can you please read these conditions for me?
Yes, all assets and liabilities of the sole proprietary concern relating to the business immediately before the succession should become the assets and liabilities of the company. The sole proprietor should hold not less than 50% of the total voting power in the company, and his shareholding should continue in such manner for a period of 5 years from the date of succession.
This is the
The
main
sole,
point. So,
yeah,
firstly, all assets liabilities should be transferred is okay. What is important is that the sole proprietor should get minimum 50% voting power in the new company, because in company there cannot be now one owner. A company requires minimum number of members to form a company, except if it is a 1%. Now, since there would be other shareholders also, the first important criterion is that this proprietor should get more than 50% of the shareholding of this company, and this more than 50% ratio should continue for a minimum 5 years, even after this succession has taken place. A similar condition is there even in case of firm converted to company. They are saying it is given at the end of the table. Okay. Where is it given at the end of the table? Yes. Now see, this is the case of succession of a firm into company. Now, if you see again here, the conditions are very similar to what we just saw for proprietor. Can you please read these conditions?
all assets and liabilities of the firm or AOP or BOI relating to the business immediately before the succession becomes the assets and liabilities of the company. To all the partners of the firm immediately before the succession become the shareholders of the company in the same proportion in which their capital accounts stood in the books of the firm on the date of succession. 3. The partners of the firm do not receive any consideration or benefit in any form directly or indirectly other than by way of allotment of shares in the company. 4. The partners of the firm together hold not less than 50% of the total voting power in the company, and their shareholding continues in such manner for a period of 5 years from the date of succession.
Same point.
5.
See,
Yeah.
same point was there in proprietorship. Here, the difference is that partners together should hold more than 50%, and this should continue for 5 years. Plus, one condition that all partners should get shares in the same ratio in which they were having their capital in the firm. In short, so basically, what you understand from this conditions or these conditions is that only the status has changed from proprietor to company or from firm to company. Internally, all workings remain same. Now, in both these, there is a time limitation of 5 years. So, until 5 years, this particular scenario should continue. Now, what does 47A considers or covers? It says that if any time before this 5 years period is over, after this conversion has taken place, if let us say the proprietor exits the company or any one of the partners exits this particular company, because of which this 50% holding by all the partner comes down. So that will become breach of the condition. And if this happens in the first 5 years, then the exemption which was given earlier will be taken back. So this is what is 47A dealing with here. Now, the only difference is we saw the implication of 47A in first case, that is holding subsidiary holding. Then in second case, conversion of stock exchange AOP BOI impact on the shareholder. Now, in both the above two cases, what was common was that the tax would be payable in the year of original transfer. However, here the difference is the tax, that is the capital gain, which was earlier exempt, would become taxable in the year in which the conditions are breached. So let us say in 23-24 this conversion had taken place, and now in 25-26, after 2.5-3 years, one of the condition is breached. Then this 47A triggers today. And since it triggers today, an interesting point is it is taxed not in the hands of the original proprietary firm or partnership firm, it is taxed in the hands of the company. Obviously, today the proprietorship or the partnership firm is not in existence because it is being subsumed in this company. So, what is the difference in this 47A implication is that it is taxed in the hands of this new company. So, that is what is an important point that you need to keep in mind. Then the fourth tax implication is again, whenever there is conversion of a public company, unlisted public company into LLP or of a private company into LLP, again, there is some impact on the shareholder. What is the impact on the shareholder? The shareholder was earlier holding shares in this old company, which is converted to LLP. Now, what will happen in his hands? This shares which he was holding will be given back, and in exchange he will get the rights in this LLP. So he was holding the shares in the previous company. Now since the company got converted to LLP, what will happen in the hands of this shareholder? In the hands of shareholder, he would have given back the shares and he would have got the membership or the owner partnership in this LLP. Now again, what does this section 74 says? That if subsequent to conversion of private company or unlisted public company into LLP, any of the conditions laid down in 30B are not complied with, the capital gain not chargeable in 45 would be deemed to be chargeable in the previous year in which the conditions are not complied with in the hands of the LLP or the shareholders of the predecessor company. So now, if any of the conditions are breached, again the tax liability would be today, that is in the year of breach. And obviously, it will be in the hands of the person who is present today. So, one, it will be either in the hands of the LLP or the shareholders. Now, what is 13B conditions? Let us just go back to see. Mm, hmm. So, 13B, transfer of capital asset or intangible asset by a private company, unlisted public company to LLP. So the company is transferring its assets to LLP. Second, the shareholder is giving away shares, and in exchange, what he is getting is he is getting the rights in the LLP. Now, in this case, yes, please read.
Share held by shareholder to LLP in a conversion of private company into an LLP. Section 4713B. Number 1. Any transfer of a capital asset or intangible asset by a private company or unlisted public company to a LLP or 2. Any transfer of a share or shares held in a company by a shareholder on conversion of a company into a LLP in accordance with Section 56 and Section 57 of the Limited Liability Partnership Act 2008.
Now, this is not
Conditions.
transfer subject to following conditions. Yes.
Conditions. Number 1. All assets and liabilities of the company immediately before the conversion became the assets and liabilities of the LLP. 2. All the shareholders of the company immediately before the conversion became partners of the LLP, and their capital contribution, and profit sharing ratio in the LLP are in the same proportion as their shareholding in the company on the date of conversion. 3. No consideration other than share in profit and capital contribution in the LLP arises to the shareholders. 4. The erstwhile shareholders of the company continue to be entitled to receive at least 50% of the profits of the LLP for a period of 5 years from the date of conversion. 5. The total sales, turnover, or gross receipts in business of the company should not exceed rupees 60 lakh in any of the 3 preceding previous years. 6. The total value of assets as appearing in the books of account of the company in any of the 3 previous years preceding the previous year in which the conversion takes place should not exceed rupees 5 crore. And 7th, no amount is paid either directly or indirectly to any partner out of the accumulated profit of the company for a period of 3 years from the date of conversion.
Now, this fifth and sixth conditions, both these are conditions before the conversion has taken place. So, in short, the objective of fifth and sixth condition is to ensure that only small companies convert to LLP. That is, the companies whose turnover was below 60 lakhs in past 3 years and whose total asset value never exceeded 5 crores. Fine. We are not bothered with this because only once you have satisfied this condition, you would have converted. Our concern is point number 4 and point number 7. Because point number 4 says that after conversion also for next 5 years, the erstwhile shareholders who have now become partners in the LLP should be receiving at least 50% of the profits. So same condition, what we were seeing in proprietor or partnership form to company, same is from in company to LLP, that the shareholders of the old company should get minimum 50% share in profits in the LLP, and this should continue for 5 years. Similarly, the seventh condition is there is no payment directly, indirectly to any partner out of the accumulated profits of the company. Now, what has happened? If you know that in case of company balance sheets, we have capital separate and we have reserve, surplus, accumulated balances separate. Whereas in case of partnership firms, there is no such separate balance. Generally, it is all merged in capital account only. However, here, if the old company had any accumulated profit balance, obviously that is also transferred to this new LLP, that should continue as accumulated profit balance and it should not be given to any of the partners directly, indirectly up to a period of 3 years. So these are the two conditions, condition 4 and condition 7, which 47A is targeting. So 47A says that after conversion, these two conditions should remain intact for 5 and 3 years as required. But if you breach any of these conditions, then what will happen? Then the tax liability will trigger in the hands of this new LLP. Because now see again, the old company has been dissolved, it has been merged. So you cannot go back and tax the old company. So firstly, they are taxing in the current year only. They are not asking you to do recomputation because there is no use asking you to do recomputation because that old company is not in existence. So since now the old company is not there, hence you make them tax in the current year only. That is the year of breach of these conditions. And it is to be taxed in the hands of the new entity, which is the LLP or the shareholders of the predecessor company. I hope this is clear to everyone. Yes, students?
Clear.
So this is what we have discussed. Again, some special case scenario dealing with section 47A. What it deals with: withdrawal of exemption under section 47. Actually, it is using this term withdrawal of exemption. There was no exemption, but since 47 regarded certain transactions as not transfer, so it is using this word exemption. So what are the case scenarios covered? Holding to subsidiary or subsidiary to holding. Second, in case of conversion of recognized stock exchange from AOP to recognized stock exchange company, the impact was on the shareholders. The person who was a member here, he surrendered his membership and in exchange he got the shares. So this is the second scenario covered. Third scenario is proprietorship to company or partnership firm to company. And the fourth scenario is company private or unlisted public company to LLP. Now, the only difference is in these two scenarios, you withdraw exemption by taxing capital gain in original year. And here, exemption is withdrawn by taxing capital gain in current year. That is the difference in 47A tax treatment for these four scenarios. Now we did this entire 48. Okay, let me come down directly to where we were. Now what we are discussing, students, we are discussing the special scenarios of cost of acquisition, which is there in section 49. So this is what we are continuing from previous class, cost of acquisition in different special cases. Now in this, we were on this point, and that is where I went back to 47A to complete that case scenario. Now when we read this, this will make more sense to you. Please read.
Yes, section 49(3). Capital asset transferred by holding company to its wholly owned subsidiary Indian company or vice versa in case of attraction of section 47A, where the capital gain arising from the transfer of a capital asset referred to in section 47(4) or section 47(5) is deemed to be income chargeable under the head capital gains by virtue of provisions contained in section 47A. The cost of acquisition of such asset to the transferee company shall be the cost for which such asset was acquired by it.
So now please understand what is this point dealing with. We have a golden rule which says where something is received by you in one of the methods which is not a transfer. In such case, your cost is cost of previous owner. So if let us say holding has given some asset to subsidiary and this is not a transfer, then in the hands of subsidiary, the cost is cost of holding. But this is if 47 is applicable, that is no transfer survives. However, if 47A is attracted, means what? 47A is attracted means now this scenario has become the case which is now regarded as taxable transfer because one of the conditions of 47 is breached. In such cases, we will not apply our golden rule 1. We will go back to the normal rule. What is the normal rule? The cost of acquisition of such asset to the transferee company shall be the cost for which such asset was acquired. So now no need of any golden rule. The cost will be as per the normal provisions. That is the price at which you have acquired. This is fine. Just a minute, I'll plug in the charger. So this is what is 49.3. So 49.3 takes us back to the original rule. Why? Because no transfer has been breached. So it has become taxable. And if it has become taxable, our golden rule is not applicable anymore. You go back to the main rule. Now we come to our golden rule 2. What was our golden rule 2, students? That where at the time of receiving an asset, it becomes taxable. Means when the asset is received by you, at that time there is some provision in the income tax law which asks you to consider it as income and requires you to pay tax on receiving of the asset. Then my golden rule 2 says the cost of this asset which has become taxable at the time when you receive the asset. See, normally capital gain or tax should apply whenever you transfer the asset. But if you receive the asset and capital gain not capital gain, income tax attracts, then golden rule 2 says the cost of such asset will be the value which is taken for the purpose of computing the income at the time of receiving this asset. Now, one case scenario we had already discussed. What was that case scenario? The case scenario was ESOP, correct? Now, the second case scenario is where the asset is received by you as gift. Now, asset is received as gift, which is taxable under section 56 to 10. Now, I hope you all remember, students, that there is a provision under the head other sources where it says that if gift is received from unrelated person and certain conditions are given, the gift is not taxable. However, if any of those conditions are not met, then the gift which is received is taxable. So let us say you receive some property, some asset from an unrelated person. If you are receiving it from an unrelated person, that gift is taxable. Or the other conditions which are it should not be received on the occasion of marriage, or the other condition is that not at the time of death of a person, in contemplation of death of the person. If any of those conditions exist, the gift is not taxable. But in all other cases, the gift is taxable. So let us say you have received an asset in the year 23-24, and that particular gift was taxed under 56 to 10. Then in such cases, today when you sell this asset, what will be the cost of acquisition of this asset? The cost of acquisition will be the same amount which was considered as gift income under section 56(2). So this is our golden rule, where at the time of acquisition of a capital asset, the assessee was liable to pay income tax. Then what is the cost of acquisition of such capital asset to you? It is the amount considered as value of the asset for computing income and paying income tax. So the second case scenario is section 49(4). That is asset which is received as gift and the gift was taxed under 56 to 10. Please read.
49.4. Property subject to tax under section 56 to 10. Where the capital gains arises from the transfer of such property which has been subject to tax under section 56 to 10, the value taken into account for the purposes of section 56 to 10.
So whatever is the value which is considered as income for the purpose of computing gift income under 56 to 10, the same value is now considered as the cost of that asset. Fine. Now this is something interesting. What did I do? Now this is something interesting. Again, for this, we'll have to first go back to this section. Now, what is this section? 10 bracket 37A. Now, we all know section 10 is for exemption. Now, this is our first exemption that we are studying with respect to capital gain chapter. Now, what is this exemption? I'm sure you all would be knowing that there is a split in multiple states whereby a bigger state is split into smaller states. The same thing happened with Andhra Pradesh, where Andhra Pradesh got split into two smaller states. One is Andhra and the other is Telangana. Now, interestingly, originally the capital of Andhra Pradesh was Hyderabad. However, this has come under Telangana. So today, Hyderabad is the capital of Telangana. But the question is, then what is the capital of Andhra Pradesh? Anybody knows what is the capital of Andhra Pradesh? The newly formed Andhra Pradesh?
Sir, Telangana.
No, Telangana is the other state, beta. So Andhra Pradesh broke up, and one is Andhra, one is Telangana. Both are states. Now I'm asking, what is the capital of this new state, Andhra Pradesh? Telangana is another state which is split up and formed.
Okay.
So originally it was Hyderabad, but Hyderabad has become capital of Telangana, the other state which is formed. So my question is, what is then the capital of Andhra Pradesh?
Amravati.
Yes. So the government has planned to make Amravati as the capital city of this newly formed Andhra Pradesh. But understand, students, to make any city as a capital city, what will happen in capital city? The entire secretariat, parliament, even high courts, and all the government related setup is required. Now, Amravati, since originally it was only one of the cities of this old Andhra Pradesh, to make it a capital city, you have to first bring in all this infrastructure. And for this, you require acquisition of land. So what happens in such cases? The government comes up with this type of a scheme, which is over here called as land pooling scheme. Now, this particular scheme says that it will take up land of all the people who are staying there. Why it is taking up the land? So that once the government gets the land, then it will make all these, it will set up a parliament, it will set up a secretariat, it will set up all these constitutional bodies which are required in a capital city. So all these offices would be established, plus then the residence of chief minister, opposition leader, finance minister, everything would be set up. So for this, the government acquired the land belonging to the people under this land pooling scheme, land acquisition scheme, whatever you can call it. Now, this obviously cannot be free because it is the legal right of these inhabitants of city of Amravati. So, in such cases, the government gives compensation. But many times, what happens? Either it is given in monetary form or the government gives something in kind form. So, what has happened in 1037A? The government was a chart here. So, what did the government do? Instead of giving money, the government gave them LPOC, land pooling some certificate. So instead of giving the people money, since obviously the new government did not have that much money to pay off the amount towards the land, what it did was, against acquisition of this land, it gave them some certificate. Now, what are the possibilities? First, the landowners are selling the certificates itself, that is exempt from capital gain tax. Firstly, before that, when they gave up their land and against that they received LPOC, that first transfer of land itself is exempt. Second, if this LPOC is further sold by them, that is also exempt. Second, against this LPOC, they received reconstituted plot or land. So what has happened? Maybe from that area, the government shifted them to another area. So against the LPOC, the government gave them land or plots in another area. Now, if they are allotted land or plot in another area, then if they sell this new plot or land within 2 years, again, that is exempt. Only if this new plot is sold after 2 years from the end of the year in which they receive, then it is subject to capital gain. So 1037A gives threefold exemption. First, against the land building which the government has taken up under this land pooling scheme, they allotted LPOC. That first transfer of original land building is exempt. Then if this LPOC itself is sold, that is exempt. If against LPOC they received another piece of land and they sold it within 2 years, again it is exempt. Only if they sold this new land after 2 years, that was subjected to capital gains. So this is what is the entire 1037A. Now, once you understand this, the question is what is the cost of acquisition? Because what we are dealing over here is the concept of cost of acquisition in special case scenarios. Please read. 1 second. It starts from here. Please read.
Section 49(6) specified capital asset referred under clause C of the explanation to section 1037A, where the capital gain arises from the transfer of a reconstituted plot or land received by the SSE in lieu of land or building, or both, transferred under the land pooling scheme of Andhra Pradesh, which has been transferred after the expiry of 2 years from the end of the financial year in which the possession of such plot or land was handed over to the SSE. The cost of acquisition of such reconstituted plot or land shall be deemed to be its stamp duty value as on the last day of the second financial year after the end of the financial year in which the possession of the said plot or land was handed over to the SSE.
Now, in this whole 1037, only this last case scenario is liable to capital gain. And that is why we require cost. So what has happened? Originally, you had, let us say, you were residing in a particular bungalow over there. Now, government took away that entire piece of land, obviously, so your entire bungalow is gone. And again, that they give you some plot of land somewhere in the outskirts. Now, this new plot of land which you have received, if you sold it within 2 years, there was no capital gain. But if you sold it after 2 years, there was a capital gain. Now, the question is, if you are selling this new plot of land after 2 years, what will be considered as the cost of acquisition of this land? Because this land you got as a consideration for your original bungalow, which was taken over by the government. So this new plot of land, what will be the cost? So they are saying the cost of this new plot which you received in exchange will be the stamp duty value. Now, stamp duty value when? At the end of the second year. Because anyway, up to 2 years, if you are selling it, there was no capital gain. So only when you are selling it after the end of 2 years, there would be capital gain. So they are saying you will take the stamp duty value as on the 31st March of the second financial year after the end of the financial year in which the plot was allotted. So let us say, if I have to put it here, section 49(6). So let us say you had a bungalow. This bungalow was acquired by the state under this pooling scheme, and against this bungalow you were given an open plot. Now this was given to you on 21st of May 2023. Now, what will be the cost of acquisition of this plot? The answer is, it is the stamp duty value on 31st of March. Can somebody give me the year? Students, what will be the year?
The 31st March 27.
27 or 26?
2 years from the end of the financial year in which it was given. So 23-24 is the year in which the plot is allotted, and then 2 years will be 24-25. Yes, 24-25. Yes, 24-25-26. Yes, 31st March 26.
The year end of this is 31st March 24. Correct, na? So you
Yes,
are
yes.
allotted on this date. The year end is 31st March 24. From that 2 years.
31st March 26.
Correct?
Yes, correct.
So we are talking about the cost of acquisition of this plot. See, bungalow to plot is exempt. So no question of finding out the cost of acquisition of bungalow. And anyways, it is your actual cost. But here we are talking about this plot because now what you will be selling is this plot. So cost of acquisition of this plot will be the stamp duty value after the end of second year from the end of the year in which you receive this plot. So you receive the plot on 21st May 23, end of the year is 31st March 24. From that 2 years. So it will be 31st March 26. Correct?
Correct.
And this is whole 1037A. Now we come to another special case scenario 45.5A. Now again, let me first explain you what is this 45.5A. So I'll bring this out. Now, what are we talking about? We are talking about a special case scenario 45.5A. It applies to specified agreements. This is the name used. And what are these agreements? It is joint development agreement called as JDA. Now, students, let us first understand what is a JDA. So let us say I am the landowner. Now, I am individual. So I am VGP, individual landowner. Now, this land is at a very prime location in the city and it is worth 100 crore rupees. Now, you are a builder developer. Now, this is a very prime plot, and you know that if you construct some building, commercial, residential, it is going to be a very profitable project. However, outrightly buying a 100 crore plot and then further spending more 200, 300 crore rupees on construction and all the amenities could be very costly. So nowadays, a new format has come where both of these come together and they jointly develop this property under this agreement called as JDA. So under JDA, what happens? Landowner is not selling the land to the builder. It is allowing the builder to develop on his land. So land already belongs to the landowner, but he allows the builder to develop. Now, how does he allow the builder to develop? By giving his development rights. So development rights is the right which allows any person to construct building on a land. So in order that you construct building on the land, you need this right, which is also called as similar to FSI. So we say that this land has 2 FSI, this land has 1.5 FSI. So that is what is the development potential or development rights. Now I transfer to the builder this development rights. Now using my development rights or FSI, the builder is going to construct this building. And let us say this building will have 100 flats, units, whatever you want to call it. Now, since I have given the builder my development rights, then the builder has to give something back to me. So what this builder or developer is giving back to me against my land, the builder developer is giving to me 40 flats. So from the side of landowner, please understand what is happening. Landowner to builder, there is transfer of development rights, DR. And from builder to landowner, there is transfer of 40 flats. Now here we are not considered with the builder side because what builder is giving to me is his PGBP income because builder in the business of constructing and selling the flats. What we are concerned is the tax treatment in the hands of the landowner who is giving away his development rights to the builder and in exchange getting flats. Now, before this section 45(5)(a) was there, what was the problem? The problem was, I'll give you some timelines. So this JDA, Joint Development Agreement, was entered, let us say today. So it is 9th September 2025. Now this JDA would be completed, let us say it will take around 5 years. So this entire project will get completed in 2030 when the completion certificate would be received, completion certificate to the building, which is called as OC or CC. OC stands for occupancy certificate, CC stands for completion certificate. In some states, they call it as BUC, building some certificate. So it is simply the date of completion of this project. Now, what were the original challenges when this section was not there? The original challenges, landowner had to pay income tax in year of JDA. That is this. But she did not receive any consideration. Why? Because consideration I'll receive at the end. See, when I will get this 40 flats, only when the building is complete. And only then can I do anything of this 40 flats. Now, the first challenge was then the landowner was required to pay income tax immediately, though he had not received any money. Second very big challenge was valuation of what the landowner has given. What the landowner has given is development rights, and in return, what he is getting something in kind, that also after 5 years. But if I have to pay tax today, I'll have to find the valuation of this development rights, which is again a very tricky affair because what I'm receiving as a consideration is going to be received after 5 years, and nobody knows what will be the value of these flats after 5 years. Now, these were the challenges being faced when there was no 45(5). When there was no 45(5), so the capital gain was taxable under the original charging section 45(1). But since these problems were faced, so this new charging section 45(5)(a) was brought in. What it did, it solved the first problem. It said that landowner pays income tax on this capital gain for transfer of development rights when in year of CC. So instead of 25, now I will be paying tax in 2030. So first benefit, first relief, I don't have to pay anything immediately. And anyways, I have not received anything now. So it was difficult for me to pay tax because I did not receive any money. Second, this amount. Now, you have deferred my tax liability to the 5th year. But now the second question is, in the 5th year, when I have to compute capital gain, I require FVC, full value of consideration of development rights, which I have transferred to the builder. What is it? It is the stamp duty value of flats received. Now, what I'm going to receive against my development rights, these 40 flats. So the law said, now they are giving me the valuation also. And there is no challenge in finding stamp duty value. When the 5th year will come, 2030 will come, the government would have announced the stamp duty value. I will take the stamp duty value of these 40 flats. That will become my consideration. So these problems were all solved. Now, what we are going to discuss over here in this point is what is the cost of acquisition of these flats. So whatever flats I'm receiving, by giving my development rights, I've received this 40 flats. Now, tomorrow I may sell these 40 flats also. So what is my cost of acquisition of this 40 flats? That is what is the point of discussion here. Yes, can anybody answer what will be the cost of acquisition of these 40 flats for me?
Stamp duty value of the flats.
Oh. Golden rule 2. You're right. What you are saying is right. Whatever is the value of these flats, see, at the time of receiving this flat, there was some income which was taxed by taking some value of these flats. Whatever is the value taken of these flats should be taken as my cost of acquisition here. Correct? Please read.
49.7. Capital asset being shared in the project referred under section 45(5)(a), where the capital gain arises from the transfer of a capital asset being shared in the project in the form of land or building or both, referred to in section 45(5)(a), which is chargeable to tax in the previous year in which the completion of certificate for the whole or part of the project is issued by the competent authority. The cost of acquisition of such asset would be the amount which is deemed as full value of consideration in that subsection, that is stamp duty value on the date of issue of certificate of completion plus cash consideration. However, this does not apply to a capital asset being shared in the project which is transferred on or before the date of issue of said completion certificate.
So, this is what is the point, that in such cases, my cost of acquisition of these flats will be as per Golden Rule 2. What is this Golden Rule 2? That whatever was my value of these flats, at the time of receiving these flats, there was some income under 45(5)(a). So whatever was the value at that time will now become the cost of the flats. This is what is our Golden Rule number 2. Correct? So let me take you. I should have written 45(5)(a). Let us, along with this, study this section also. So this section, this special case will also be covered. Taxability of capital gain in case of specified agreements, 45(5)(a). Please read.
Yeah. Taxability of capital gains in case of specified agreement, section 45(5)(a). Genuine hardship on account of taxability of capital gains in the year of transfer of property to developer. The definition of transfer inter alia includes any arrangement of or transaction where. So I have to read previous page. Yeah, here. The definition of transfer inter alia includes any arrangement or transaction where any rights are handed over in execution of part performance of contract, even though the legal title has not been transferred. Applying the definition of transfer under these development agreements, the transfer took place in the year in which the owner of the immovable property, being land or building or both, handed over the immovable property to the developer. Consequently, the capital gains tax liability in the hands of the owner would arise in the year in which the possession of immovable property is handed over to the developer for development of a project, in spite of the fact that the consideration thereof, that is the actual constructed property, will be received only after a couple of years.
So this was the challenge originally. So in such cases, since I have given the possession of my land to the developer so that he could come and construct. So if you remember, there is a concept in the definition of transfer, part performance. So here part performance has happened. I have given the physical possession. So from my side, transfer has taken place. But I did not receive any amount, or maybe I may have received only some very small portion in money terms. But the major portion which I'm going to receive is in the form of the flats. Now, in such a case, the practical challenge, as I said, was 2. 1, I have to pay tax immediately. 2, the valuation of my development rights was uncertain. To overcome this new section was introduced. Please read.
Deferment of taxability of capital gains with a view to minimize the genuine hardship which the owner of land or building may face in paying capital gains tax in the year of transfer. Section 45(5)(a) provides that in case of an SSC being individual or Hindu undivided family who enters into a specified agreement for the development of a project.
This is the joint development agreement. So joint development agreement is what is called a specified agreement. Remember this term specified agreement because this is repeated everywhere in the Income Tax Act, not only this chapter. So in TDS also you'll have reference to this, where again they will say specified agreement under 45(5)(a). So just remember, wherever they say 45(5)(a) and specified agreement, what they're talking about is joint development agreement. Yes.
The capital gain arises from such transfer shall be chargeable to income tax as income of the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority.
So it will be
Main-
taxed now at the end, not at the start. So originally transfer has taken place at the start, but 45(5)(a) has given the first benefit of deferring the liability to the end. Proceed.
Meaning of specified agreement. Specified agreement means the registered agreement in which a person owning land or building or both agrees to allow another person to develop a real estate project on such land or building or both in consideration of a share being land or building or both in such project, whether with or without payment of part of the consideration in cash. Full value of consideration. For the purposes of Section 48, the stamp duty value of his share being land or building or both in the project on the date of issuing of said certificate of completion as increased by any consideration received in cash or by check or draft or by any other mode, if any, shall be deemed to be the full value of consideration received or accruing as a result of the transfer of the capital asset.
So what will be the full value? It will be the stamp duty value of his share. Now, what is the stamp duty value of his share? In my example, it is 40 flats. So he has received 40 flats as the share of his means landowner share in this particular project. And you have to take the stamp duty value of this when on the date of the completion certificate. So they have now made it simple. Since the valuation was not clear, they have even given the valuation. Please.
Non-applicability of the beneficial provision. It may, however, be noted that these beneficial provisions would not apply were the assessee transfers his share in the project on or before the date of issue of the said completion certificate, and the capital gains tax liability would be deemed to arise in the previous year in which such transfer took place. In such a case, full value of consideration received or accruing shall be determined by the general provisions of the Act proviso to Section 45(5)(a).
Now, what this point says, it says that this benefit of 45(5)(a) of deferring will not apply. When it will not apply? If the assessee, who is the assessee? Landowner. If he sells any of his flats before this completion certificate. So I'm supposed to receive 40 flats. I should sell not even a single flat, not even single out of 40 before this completion certificate happens. If I sell even a single of my flat before this completion certificate happens, then this benefit of deferment will go and I will be required to pay tax as per the original provisions of 45(1), whereby I would not be having the benefit of deferment. I have to pay tax in the first year, that is the date of JDA, in the first year itself. And what is the value? They've said that the value will be as per the general provisions, which was anyways not certain. So it was also indecisive. So in short, I'll go back to the original problem. If I decide not to follow this, what I have to follow? I don't have to sell even one single of my flat before the completion certificate. So this is what you have to remember, that this particular section comes with this rider clause. Correct? So here they have given it in graphical form. I have given to you in some monetary valuation form so that it is easy when some monetary things are given. So I hope that is clear to everyone. Is this fine?
Clear. Clear.
Perfect. So let us go back to where we were. So we were on 49.7, where we were trying to find out the cost of acquisition. And here I said cost of acquisition is as per our golden rule number 2. So what is our golden rule number 2? Whatever is the sale value or the value of the flat taken here for computing income, that same value which is taken of this flat for computing income, which income? Capital gain on transfer of development rights, that becomes the cost of acquisition here. So this is as per section 49(7). Correct? So maybe I can put the same here. Section 49(7). Development rights. And I receive flats. Now I want cost of acquisition of these flats. So it is stamp duty value of flats on date of CC. Correct? Understood, students?
Yes.
Perfect. Yes. Now see, these are all those scenarios which are falling in my golden rule number 2. But these are covered in some different chapters, so it will be slightly difficult for us. So I'm just for the time being skipping. You study this more in chapter 10. But let me take you to this. This is what you would have studied in PGBP. Correct? What are you asking, Geet? Cash received of, yeah, obviously. So if there is any cash received, that will also be part. So but that cash received beta is part of full value of consideration, not cost. For cost, it is only the stamp duty value, which is the cost. So cost will not include cash receipt. Be clear with this. Correct? Correct na beta? Now, 49(9). Please read.
Yeah, 49(9). Capital asset which was used by the SSE as an inventory before its conversion into capital asset, where the capital gain arises from the transfer of a capital asset which was used by the SSE as inventory earlier before its conversion into capital asset, the fair market value of the inventory as on the date on such conversion determined in the prescribed manner.
Again, student, this is our golden rule number 2. Again, how? See, what was our golden rule 2? Oh. Flats under JD. Now, what is this point that we are discussing? This point is of PGBP. Now, in PGBP, we have the reverse scenario. What is the reverse scenario? What you have is stock in trade. Now you decide to treat this stock in trade as your capital asset. So what is the example? Same example of builder developer. The builder developer had constructed different shops for selling it. So these shops were held by my stock in trade. However, after 3-4 years, since these shops were not getting sold, he decided that he will make these shops as his own corporate office. That is his administrative office or the office where he will sit for doing his business. Now, the moment he starts using these shops, which are originally meant for sale, which is originally stock in trade, or sitting there for doing his own business, in that particular case, what he is doing is he is now treating it as his fixed asset or capital asset. Now, in capital gain chapter, we studied capital asset converted to stock in trade. Fine. But this scenario is covered in section 28, that is a charging section of PGBP. It says that what if you convert stock in trade into capital asset, this will be regarded as PGBP income. So conversion of stock in trade into capital asset is PGBP income. Conversion of capital asset into stock in trade is capital gain income. Simple. Now, for taxing this PGBP income, they say that we will take the fair market value of this flat on date of conversion. So for computing PGBP income, they will be considering fair market value of the flat. Now, same point, we come back here. So this same SIT, which is converted into capital asset. So now when this capital asset is created, it is leading to an income under PGBP. So now this section says what will be the cost of acquisition? The cost of acquisition will be the same amount which is considered as income of PGBP, that will become cost of acquisition for capital gains. So the logic remains same. So the logic is what is sale over there will become cost over here. So SIT converted to capital asset. What is the cost of acquisition of this capital asset? It is the FMV on date of conversion. Right? Understood, students?
Right, yes.
Please read. Next.
Section 49, Clause 10. Capital asset being an electronic gold receipt or gold. Where a capital asset being an electronic gold receipt issued by a vault manager became the property of the person as consideration for transfer of gold, Section 47(7)(d), the cost of gold in the hands of the person in whose name electronic gold receipt is issued.
Again, this is a case of golden rule 1. Gold converted into electronic receipt. What will be the cost of acquisition of electronic receipt? Cost of gold. And second, where vice versa happens, you give the electronic receipt and get back gold. Now, what will be the cost of gold? The cost of gold will be the cost of electronic receipt. So it is same like golden rule 1. Fine. And then this is 55(2). This is the reiteration of the entire cost of acquisition provision that we studied till now. If you remember, we studied this from the Act itself, and now they have reproduced it here. So this is all what we have already studied: a cost of acquisition of intangible assets, cost of acquisition of assets where it is converted from one form to another, but that conversion is not transfer, etc., etc. Fine. So we'll take a break over here, and after the break, I'll come back with a very interesting section, slightly tricky one, but it is going to be interesting. Fine. Chalo. So 15 minutes break, and we rejoin at 8:03. to this another special case. Slightly tricky, but once you understand the ideology, the logic behind this particular provision, understanding what is there would be easy. Nine B, yes, that will do. That will do it. So now once we have completed many provisions, now I am taking you all to all the special case scenarios one by one. Yes. Now what is this 112A? Okay. Now, as we have a change this year in computing capital gain without indexation, and then for individual you have an option. Similarly, there is this section 112A. This was brought in by your Finance Act 2018. Now, what does this particular section did? So before this section, capital gain was calculated as what we have been studying, full value minus expenses minus index cost of acquisition. However, this section for the first time when it came in, it applied to some specified assets. What are these assets? These are equity shares and units of equity oriented funds, both listed. Now, what this particular section 112A said, that if your assets are listed equity shares or listed units of equity oriented fund, then if at the time of purchase and sale both, and here at the time of sale, you have paid STT, that is the securities transaction tax, then the capital gain would be computed without indexation, and it was taxable at a lower rate of 10%. Now in this year, as you all know, the rate has become 12.5 without indexation. So now this section also has two rates. If a transfer is up to 22nd July 2017, and if it is 23rd Now, most important, interesting point is tax on capital gain exceeding rupees 1,25,000. So,
is it 23rd July 2017 or 2024?
24. Sorry. It is this year. So originally when this section was brought in, there was only one rate, the reduced rate of 10%. But from this year, now as for all other capital gain, without indexation, the rate has been 12.5. So for this also, the rate is 12.5. Now what is very interesting is the cost of acquisition. But before I come to that, let us first understand the other things. So this section was specifically aiming our stock market. And it said that for those who are investing in stock market and they are selling the assets. Now, most important point is that it covered only two assets: equity shares, units of equity oriented fund, and that also if they are long-term capital asset. Now, as you all know, for becoming long-term, the time period is 12 months. So if you are selling these assets after 12 months, that is they become long-term capital asset, and STT has been paid. This is the most important point. STT has been paid. Now, in case of shares, both at the time of purchase sale, and in case of units of equity oriented fund, only at the time of sale. So if these conditions all were satisfied, your case was covered in this special computation section 112A, which provided that capital gain would be computed without indexation, like how from this year this has become compulsory. At that time, this was applicable only to specified assets. And most interesting part is there will be no tax on capital gain up to 1,25,000. So up to 125, even if you get gain in this particular section, the gain would be considered as non-taxable or zero. So this is the special provision. There are a few more special points, but these are the basic crucial pointers. So let us go to the details. Can you please read for me?
Yes, Section 112A, applicability of concessional rate of tax. Section 112A provides that notwithstanding anything contained in Section 112, a concessional rate of tax will be leviable on the long-term capital gains exceeding 1,25,000 on transfer of an equity share in a company or a unit of an equity-oriented fund or a unit of a business trust. Yeah, concessional rate of tax in respect of LTCG on transfer of certain assets. The concessional rate of tax on long-term capital asset in respect of transfer of above-mentioned assets is as follows. Date of transfer before 23rd July 2024. Rate of tax 10% on LTCG exceeding rupees 1,25,000. On or after 23rd July 2024, 12.5% on LTCG exceeding 1,25,000. However, the total exemption on LTCG in the previous year cannot exceed rupees 1,25,000.
What does this mean? That if you, in a year you have multiple times, let us say you are selling shares at different points of time. So every time you will be computing capital gain, and let us say you satisfy the conditions of this section. So you are computing capital gain under this section where up to 125 there is no tax. That 125 is not on sale of each share. It is during the whole previous year, all the shares which are sold, which fall under this section, cumulatively 125 will not be taxed. Beyond that, it will be taxable. Conditions.
Conditions. The conditions for availing the benefit of this concessional rate are: A. In case of equity share in a company, STT has been paid on acquisition and transfer of such capital asset. B. In case of a unit of an equity-oriented fund or unit of business trust, STT has been paid on transfer of such capital asset. However, the central government may by notification in the official gazette specify the nature of acquisition of equity shares in a company on which the condition of payment of STT on acquisition will not be applicable.
Okay.
Accordingly, the central government has wide notification number 60 2018 dated 1st October 2018 notified that the condition of chargeability of STT shall not apply to the acquisition of equity shares entered into before 1st October 2004 or on or after 1st October 2004, which are not chargeable to STT other than following transactions.
See, STT was brought into the law from 1st October 2004. Hence, they gave a clarification that if any equity shares are acquired before that date, then obviously we can give a condition that STT should have been paid because STT was itself not applicable before 1st October 2004. So if shares are acquired before 1st October 2004, then the condition of making payment of STT is not there. And then besides that, they have made a list of few transactions where again, this condition that STT should have been paid has been relaxed. Now, these are again those transactions where because of the nature of these transactions, STT is not paid. Like, for example, I have equity shares, but I directly give it to you. That is, I directly transfer to Geet, let us say, without routing it through stock exchange. Now, I can transfer the share directly to Geet from my Demat account to Geet's Demat account. I need not go to the stock exchange. I need to go to the stock exchange when I don't know the buyer or the seller. When I know the buyer seller, I can do the transaction directly. Similarly, let us say on the death of a person, if the shares automatically become the property of the legal heirs. So these are certain cases listed above where the condition that the estate should have been paid has been relaxed. Fine, but we are not concerned with that list. Now the main part. Point number 3.
Adjustment of unexhausted basic exemption limit. In the case of resident individuals or HUF, if the basic exemption is not fully exhausted by any other income, then such long-term capital gain exceeding 1,25,000 will be reduced by the unexhausted basic exemption limit, and only the balance would be taxed at 10% or 12.5% as the case may be. However, the benefit of adjustment of unexhausted basic exemption limit is not available in case of non-residents. It is also not available in case of resident AOPs and BOIs.
Okay, do you all know what this particular point means, students?
Yes, if the basic exemption say is 3 lakh rupees, then up to 1 lakh 25,000, it will be
Yes.
there will be
tell
no
me.
tax on above 1,25,000. If it is above 1,25,000 up to 3 lakhs, say, so it won't be taxable. It will be adjusted.
Let us say a person has income from salary rupees 2,50,000 and he gets LTCG under 112A of rupees 6,50,000. Now, the gross total income of this person comes to 9 lakhs. Fine. Now, when you are computing tax, how do we compute tax? Salary 250 and LTCG 112A is 650. Now, let us say the basic exemption limit. You all know what is the basic exemption limit? It is the amount up to which tax is not applicable. Now, that depends upon whether you are senior, not senior, old scheme, new scheme. So, for simplicity, let us say we are talking about the basic exemption limit of 350. Now, in this particular case, his salary income is only 250, whereas the basic exemption limit is, let us say, 350. So, this 1 lakh is called as the unexhausted. That is which he could not utilize, because the rule says that you should first utilize your basic exemption limit towards your regular incomes. See, 112A and all these which have special tax rates are special incomes. Now, if you are unable to utilize your basic exemption limit against your regular incomes, then you will adjust it here. But this adjustment is allowed only if the assessee is a resident individual or resident HUF. For any other assessee, this adjustment is not allowed. So because of this adjustment, now my capital gain is this, out of which I get a relaxation of 125 as the law is. So effectively, my tax will be this. Assuming this capital gain has arisen before 23rd July 24. If it would have arisen after 23rd July 24, I would have taken 12.5%. So this is what is this adjustment of basic exemption limit. I hope this calculation is clear to everyone.
Yes, clear.
Yes. Proceed. Point number 4.
No deduction under Chapter 6A against LTCG taxable under Section 112A. Deductions under Chapter 6A cannot be availed in respect of such long-term capital gains on equity shares of a company or units of an equity-oriented fund or units of a business trust included in the total income of the SSC.
Go ahead.
5. No benefit of rebate under Section 87A against LTCG taxable under Section 112A. Rebate under Section 87A is not available in respect of tax payable at the rate of 10% on LTCG under Section 112A.
So these all benefits are under the old scheme, as you all know. So you have Chapter 6A deduction, you have rebate. Now, if you are following the old scheme, these deductions are allowed. However, these deductions are not allowed against special rate incomes like 112A. So against 112A, you cannot take the deduction under Chapter 6A, nor you can take the rebate under 87A. So this is what is an important point to be kept in mind. Now, what is very important is the main point why we came to this section, that is cost of acquisition of these shares. Now, what is this point? Let us understand. See, now in this, there is a very interesting point of cost of acquisition of these specified assets. Now see, before this section, that is before the Finance Act 2018, all capital gains, long-term capital gains are taxed as per section 112 at the rate of 20% with indexation. Now this particular section 112A, which was brought in, as you all know, the budget date is 1st Feb 2018. Now in this budget, on this day, this particular new provision was announced. Now definitely it had a huge impact on the stock market, and this particular section would give benefit to all those who purchase shares after this date, because definitely after this date the stock market would have boomed. Why boomed? Because you gave them a tax reduction from 20% to 10%. Okay, indexation benefit was not given, but anyways, if you see the indexation rates, it is hardly giving the double benefit, because 20% becoming 10% is rate is becoming half. So when 20% would have been beneficial if your indexation would have gone about double, which does not happen over 8 to 10 years. So many people were happy because people in stock markets are investing for a lesser period of time. In fact, very less people were investing for more than a year. So they were happy that after a year, their capital asset became long term and they were eligible for only 10%. Now, because of this, the stock market boomed. But it benefited those who are purchasing shares on or after this date, after this budget announcement, because the stock market was in boom. So their cost of acquisition would be higher and less capital gain would have to be paid. But those who would have purchased shares before this date, for them, a provision was introduced. What this provision says, that if the specified assets are acquired before this date, 1st February 18. Why 1st February 18? Because budget date when this provision was announced. Then for them, cost of acquisition was higher of actual cost of acquisition or FMV on 31st Jan. 1 second. On 31st of Jan. Now, why this was done? Because these people would not be getting the benefit of indexation, because indexation was removed, as we see 10% without indexation. So to give these people the benefit of indexation, they said, we will allow you to take your cost of acquisition as your actual cost or FMV on 1st Jan, on 31st Jan, whichever is higher. So automatically, because of giving you the option of taking FMV on 31st Jan, if definitely there was some inflation effect, that would have been adjusted and you would have got the benefit of higher of this. However, this FMV had to be compared with your sale value or the full value of consideration. Means what? That your full value at which you are selling these shares and the FMV which you are taking on 31st Jan, you have to compare both these and you have to take out of both these whichever is lower. Now this seems to be slightly confusing. At one point of time you are saying higher, at one point of time you are saying lower. So students, I'll say connected with house property. In house property, how do you find expected rent? You take MR, compare with FR, whichever is higher. And then this higher figure you compare with SR, whichever is lower. Same logic is here. You have to take actual cost, compare with FMV, whichever is higher. But this FMV cannot exceed the full value of your shares, that is the sale value of your shares. So this FMV you have to compare with full value or sale value of your shares, whichever is lower. So we proceed with it like this, that we first compare the FMV on 31st of Jan 18 with the full value of consideration of shares. And out of both these, you take lower of the values and compare this lower with actual cost of acquisition of these shares, and you take whichever is higher. So do it this way. FMV of 31st Jan, compare with your sale value of shares, whichever is lower. And this lower value compare with actual cost of acquisition of shares, whichever is higher. This is finally your cost of acquisition. I hope this is clear to everyone. See, let us understand with the help of this example. No, here they have not shown the computation. They have only wanted computation where this cost of acquisition and all is given. No. Okay, it is not here. Okay. But I hope students you understood this particular point.
Yes.
I think this will help you. See, go through this illustration. This will help you in understanding the cost of acquisition. Can you please read for us?
Scenario 1. An equity share is acquired on 1st January 2017 at 100 rupees. Its fair market value is 200 on 31st January 2018, and it is sold on 1st Jan 2024 for 250 rupees. As the actual cost of acquisition is less than the fair market value as on 31st January 2018, the fair market value of 200 will be taken as the cost of acquisition, and the long-term capital gain will be 50 rupees, 250 minus 200.
So what is our rule? You compare fair market value of 31/12/18 with the sale value of your shares. Sale value of your shares is 250, market value is 200, so whichever is lower. And this 200 compared with your actual cost, whichever is higher. So finally your cost of acquisition becomes 200 as per this rule of cost of acquisition. Subtracted from the sale value, no indexation applicable. So 50 rupees is your long-term capital gain. Now, since the transfer has taken place before July 2024, the tax rate on this 50 rupees after adjusting 1,25,000 will be 10%. Correct?
Yes.
Go ahead.
Scenario 2. An equity share is acquired on 1st January 2017 at 100 rupees. Its fair market value is 200 on 31st January 2018, and it is sold on 1st April 2024 at 150. In this case, the actual cost of acquisition is less than the fair market value as on 31st 2018. However, the sale value is also less than the fair market value as on 31st January 2018. Accordingly, the sale value of 150 will be taken as cost of acquisition, and the long-term capital gain will be nil, 150 minus 150.
Perfect. Go ahead.
Scenario 3. An equity share is acquired on 1st January 2017 at 100 rupees. Its fair market value is 50 on 31st January 2018, and it is sold on 1st April 24 at 150. In this case, fair market value on 31st January 2018 is less than the actual cost of acquisition, and therefore the actual cost of rupees 100 will be taken as actual cost of acquisition, and long-term capital gain will be 50 rupees, 150 minus 100. Scenario 4. An equity share is acquired on 1st January 2017 at 100. Its fair market value is 200 on 31st January 2018, and it is sold on 1st April 24 at 50 rupees. In this case, the actual cost of acquisition is less than the fair market value as on 31st January 2018. The sale value is less than fair market value on 31st January 2018, and also the actual cost of acquisition. Therefore, the actual cost will be 100 rupees as the cost of acquisition in this case. Hence, the long-term capital loss will be 50 rupees. 50 minus 100 in this case.
Fine. So I hope this is clear to everyone. Correct?
Yes.
I'll just add one more thing which Geet has highlighted. So this is also applicable to units of business trust. Yes. Yes. So Geet is saying cost of acquisition cannot exceed full value, as no benefit of loss need to be given. Yes, you're right, Geet. Perfect. Okay. I think we were studying this. We were studying cost of acquisition special scenarios. So we did this 112 also. Correct? ठीक है. Then, where capital asset is acquired before 1st April 2001, we know we take the actual cost, compare it with fair market value on 1st April 2001. Whichever is higher is our cost. And if the asset is land building, we compare it with stamp duty value, whichever is lower. Correct? Where capital asset becomes property in one of the modes specified in 49.1, we take cost of previous owner or previous asset. Similarly, where capital asset becomes property on distribution of capital asset on liquidation, again, the cost of acquisition in different scenarios at a glance. This is what we have been studying since our previous class. Cost of improvement also, if you remember, we studied in the previous class. First, for intangible assets, the cost of improvement will be nil. Second, for other assets, where the asset is acquired before 1st April 2001, any cost of improvement done before 2001 will be ignored. Only cost of acquisition done after 2001 has to be considered. Correct? All these things we have discussed in the previous class. Now we come to some more special scenarios. But before that, let me just put down all these points here. Cost of improvement. Correct? Now, next. Now we go to some more special case scenarios. Now we come to depreciable assets. Now, what are depreciable assets? Go back to PGBP. In PGBP, you have this specific scenario of block of assets. So now we are dealing with depreciable assets. Now in this assets covered under block of asset system, correct? Section 50A. Now students, please pay attention. Under this category of depreciable asset, the first scenario is where your asset is forming part of a block, that is, it is covered under block of assets. What does Section 50A says? Section 50A says 1. Capital gain shall always be treated as short-term capital gain. So first thing given in 50A is capital gain, whatever will be there, will be treated as short-term and not long-term. So in short, for depreciable assets, the capital gain can never become long-term. It will always be short-term. Second, capital gain shall arise only if, this is the most important point. So in case of block of assets, 50A say capital gain shall arise only if block becomes empty or WDV Now, this is the most interesting part. So there is no such condition for any other assets, but only for block of assets. The provision says you will compute capital gain, that is the capital gain liability or the capital gain computation will trigger only when first scenario, block becomes empty. What is block becoming empty?
Sale of all assets.
Yes. All assets are sold. All assets in the block are sold. Or maybe all assets are not sold, but the sale value that you are realizing, that is sufficient to wipe out your entire WDV. That is, your sale value can absorb entire WDV. In short, the WDV will become nil because of this sale value. If both these things do not happen, that is, after sale of an asset, there is still some assets left in the block, and there is still some WDV left in the block. In that case, there will be no capital gain arising. So this is the most important special aspect of Section 50A, which deals with capital gain in case of depreciable assets and which assets which are forming part of block of assets. Please read.
The transfer of depreciable assets, Section 50. Section 50 provides for the computation of capital gains in case of depreciable assets. It may be noted that where the capital asset is a depreciable asset forming part of the block of assets, Section 50 will have overriding effect in spite of anything contained in Section 242A, which defines a short-term capital asset. Accordingly, where the capital asset is an asset forming part of a block of assets in respect of which depreciation has been allowed, the provisions of Section 48 and 49 shall be subject to the following modifications. Where the full value of consideration received or accruing for the transfer of the asset plus the full value of consideration for the transfer of any capital asset falling with the block of assets during the previous year exceeds the aggregate of the following amounts, namely 1. Expenditure incurred wholly and exclusively in connection with such transfer. 2. WDV of the block of assets at the beginning of the year. 3. The actual cost of any asset falling within the block of assets acquired during the previous year. Such excess shall be deemed to be the capital gains arising from the transfer of short-term capital assets. Where all the assets in a block are transferred during the previous year, the block itself will cease to exist. In such a situation, the difference between the sale value of the assets and the WDV of the block of assets at the beginning of the previous year, together with the actual cost of any asset falling within that block of assets acquired with the SSC during the previous year, will be deemed to be the capital gains arising from the transfer of short-term capital assets.
So in simple words, in very simple words, the capital gain in such cases shall arise in one of the two scenarios. One, where all the assets in the block are sold, that is the block becomes empty, or the WDV becomes nil. Only when one of these things happen, capital gain liability will be triggered. Second, I think I made one mistake in section number. It is not 50A, 50 subsection 1, subsection 2. So one is dealing with this scenario that the WDV is nil, The other is dealing with the scenario that the block is empty. Correct? Now coming to second case scenario. A set of power units depreciated under SLM. I hope you all remember this, that for power units, there is an option that they can prefer the block method or the SLM method. If they are preferring the SLM method, then their capital gain is calculated in the normal manner like any other asset. So here, since they are not following the block method, the above rule that the block should be empty or the WDV is nil is not applicable. Here, capital gain is simply the FVC minus cost of acquisition minus the depreciation allowed. In short, the WDV. Now here, if you remember, whenever they opt for SLM method, the block concept does not apply. The working of depreciation is asset-wise. So capital gain will also be asset-wise. That is what is 50A saying. Go ahead.
Section
One second.
50.
No.
Yeah, this is yes. Cost of acquisition in case of power sector assets. Section 50A. With respect to the power sector, in case of depreciable assets referred to in Section 32(1), Clause 1, the provisions of Section 48 and 49 shall apply subject to the modification that the WDV of the asset, as defined in Section 43(6), as adjusted, shall be taken to be the cost of acquisition.
Simple. So here there is no concept of block, and in such case the capital gain will arise simply as full value minus the cost of acquisition, and cost of acquisition is after adjusting the depreciation. Now, this is a new provision, 50 capital A. Now it covers three things. One, it covers the units of specified mutual fund. Now, what are specified mutual funds? Where the per annum premium exceeds 2,50,000, what we have studied in the initial part when we were discussing the definition of capital asset. This was covered over there. Second is market linked debentures and unlisted bonds or unlisted debentures. Now, for all this, a new section 50 capital A has been introduced. And again, what it says that? It says that in case of transfer of any of these assets, whatever capital gain will be arise either on the transfer, or since these are bonds or debentures, on the redemption or maturity, it would always be considered as short-term capital gain. So what is important is, if any of these assets are transferred, the capital gain arising from the transfer or maturity of these assets will always be considered as short-term capital gain, irrespective of the actual nature of the asset. Now, out of this, for this unlisted debentures and bonds, this provision has come from this date, that is 23rd of July. For all others, this provision was there right from the start of the year. So for unlisted bonds and debentures, only if it is transferred after 23rd of July 24, and for any of the other two assets, whenever they are transferred, the most important point is they shall be treated as capital gain arising from short-term assets. In short, they shall be treated as short-term capital gain. So computation is full value of consideration received or accruing as a result of transfer, redemption, maturity of such debenture units shall be reduced by the cost of acquisition of the debenture units and the expenditure incurred wholly exclusively for such transfer. No deduction is allowed for STT. So the simple point that we are trying to make over here is, next is specified units of mutual fund, market linked debentures, and unlisted bonds, debentures, which are transferred after 23rd July 24. So for all these, a new section 50AA applies. What it says, capital gain is always deemed to be short-term capital gain. So for all these assets, the capital gain loss will always be treated as short-term. That is what is the special point. Now coming to an important section 50B. I'm sure you all know what is a slump sale. A slump sale is when you're not selling anything piecemeal. You're selling a business as a whole, along with all the assets, all the liabilities, and preferably for a single price. Then that particular transaction is called as a slump sale. Now, it may happen that you may have sold the entire business, or you may have sold one of the verticals of the business. So let us say my business I'm Samsung company. So I have the manufacturing vertical plus the after sales service vertical. Now, either I sell the whole business, that is the entire manufacturing and after sales, that is the entire Samsung business to you, or I only sell the after sales vertical to you. But that whole vertical is sold with all its assets, all its liabilities. That is what is slump sale. Now for slump sale again, there is a special tax treatment. There is a special working that we study in 50B. Please read.
Capital gain in respect of slump sale, section 50B. Meaning of slump sale, section 242C. Slump sale means transfer of one or more undertakings by any means for a lump sum consideration without values being assigned to the individual assets and liabilities in such manner. In such transfer. Term undertaking, explanation 1. Meaning it includes any part of an undertaking or a unit or division of an undertaking or a business activity taken as a whole, but does not include individual assets or liabilities or any combination thereof not constituting a business activity. Transfer, explanation 3. Meaning assigned to it in section 247, it would include sale, exchange, relinquishment of asset, capital asset, extinguishment of any rights therein, compulsory acquisition under any law, etc.
Okay. So two things they defined. What is undertaking? It can be a part of the business or a unit or a division or an undertaking or the business as a whole. So what is important is, but it will not include individual assets liabilities. So it cannot be sale of piecemeal assets liabilities. It has to be the whole business or a whole division or unit of the business which is transferred. That is what is slump sale. Go ahead.
Note, the determination of the value of an asset or liability for the sole purpose of payment of stamp duty, registration fees, or other similar taxes or fees shall not be regarded as assignment of values to individual assets or liabilities.
Now, many times what happens, I have fixed a lump sum price for your business, let us say 5 crores. But when this business is to be transferred, what will be transferred? The land, the factory building. Now, many of these assets have stamp duty. Some have registration fees, like if there are any patent copyrights, then registration fees has to be paid. Now, in order to compute the stamp duty registration fees, we may have to break up this 5 crore into individual values. But the point is what? I did not value your business piecemeal. I have valued it lump sum 5 crores, but only for the purpose of determining these all taxes and charges, we had broken up that lump sum value into value of respective assets liabilities. That will not change the nature. It will still remain slump sale. Now coming to the first most important point.
Capital gains, whether long-term or short-term, section 50B, subsection 1. Any profits or gains arising from the slump sale of one or more undertakings held for more than 36 months shall be chargeable to income tax as capital gains arising from the transfer of long-term capital assets and shall be deemed to be the income of the previous year in which the transfer took place. Any profit held with to be short-term capital gains.
Now here I have two very important pointers. One, I believe this section needs amendment. because from 23rd July 2024, that is from the second budget, you have seen that 36 months criteria is gone. Now it is only 12 months and 24 months. So I believe this 36 should also have another provision of 24 months. But fine, they may have not, the lawmakers while amending them. Now we know the period of holding. It is 24 months, 36 months, whatever. The period of holdings for determined long term. Some may be having 12 months, some may be 24 months. As per the old provision, some may be having 36 months. Plus, some may be long term, some may be short term. So, how to determine? Most important thing, students, remember, here we are not computing capital gain of one asset. We are not doing it for individual asset. We are doing it for the business or the undertaking as a whole. Hence, the period of holding should be checked for the entity as a whole. So if I'm talking for the business as a whole, I will see when I have started the business. If it is more than 36 months since I've started the business, I will call it as long term. Similarly, let us say I'm only selling one of the verticals, one of the divisions of this business. So I have to see when this division was started. If it is more than 36 months since this division was started, then it will be called as long term. So in case of slump sale, long term, short term will not depend upon individual asset. It will depend upon the starting date of the business as a whole. Now, the second important point.
Deemed cost of acquisition and cost of improvement, section 50B, subsection 2, clause 1. The net worth of the undertaking or the division, as the case may be, shall be deemed to be the cost of acquisition and the cost of improvement for the purposes of section 48 and 49 in relation to capital assets of such undertaking or division transferred. No indexation benefit would be available even if it results in a long-term capital gain, irrespective of the date of transfer of the undertaking, that is whether before or on or after 23rd July 2024.
So what is important is here, irrespective of whether it is more than 36 months or less than 36 months, indexation benefit is not available. And this is not because of this new provision. This is from day one. For slump sale, no indexation is allowed. First. Second, most important point. Since we are doing computation for the business as a whole, since we have the sale price 5 crores for the business as a whole, then for finding out capital gain, the cost of acquisition should also be for the business as a whole. And what will be that cost of acquisition? That will be the net worth. So we will take the net worth of the business or the division which we are transferring, and this net worth will be treated as the cost of acquisition. So we will not be interested in individual assets capital gain. We are computing capital gains for the business as a whole. Hence, the cost of acquisition will be the net worth of the business as a whole. So lump sale, capital gain on transfer of business as a whole or a division. Business is more than 36 months. No indexation is applicable. And most important, cost of acquisition is the net worth of the business or the division. Now you know what is the meaning of net worth. Net worth is assets minus yes, continue.
Deemed full value of consideration. Section 50B. The fair market value of the capital asset shall be the fair market value 1 or fair market value 2, whichever is higher.
Now, this is
FMV
something
1.
new. Example, I said that I am giving you 5 crore for your business. So 5 crore was full value. Now, owing to the various malpractices or people doing some adjustments, now the law has been amended to say now the full value will be the fair market value, but determined in the math. Now, what are these two different FMVs? The two different FMVs are, firstly, you have to take whichever is higher. If you have to understand these two different FMVs, the two different FMVs are simply first, the FMV of whatever assets we have sold or given in slump sale first. And FMV2 is whatever consideration you have received. If it is in money form, then money. But if it is in kind form, then the fair market value of the consideration received in kind. So what are these two FMVs? Let me explain you in brief. So FMV1 is now when a particular unit or undertaking is transferred, it is transferred with all its assets and liabilities. So you have to take the fair market value for all the assets. For land building, you have to take the stamp duty value. This is FMV1. So whatever you have transferred, to take the FMV of that is FMV1. Second, whatever you have received against this slump sale. So the payment that you have received, now many times the payment would be in money, many times the payment would be as shares of that company in which you are transferring your business, or they may in return give you back some other capital asset. So whatever you are receiving, the FMV of that. So these are the two FMVs, and we have to take higher of the two. So this is the gist. Let us go to the details.
FMV1 is equal to the fair market value of the capital assets transferred by way of slump sale determined in accordance with the formula A plus B plus C plus D minus L, where A is equal to book value of all the assets other than jewelry, artistic work, shares, securities, and immovable property as appearing in the books of accounts of the undertaking or the division transferred by way of slump sale as reduced by the following amount which relate to such undertaking or the division. Number 1, any amount of income tax paid, if any, less the amount of income tax refund claimed, if any. And 2, any amount shown as asset, including the unamortized amount of the deferred expenditure, which does not represent the value of any asset.
So what is A? So in this whole formula, it is ABCD minus L. L you can understand is the liability because we are finding out the value of the business, which is obviously with assets and liabilities. So liability has to be subtracted. But first in A, you take the book value. Now see, we had to find out the fair market value of asset transferred, but we are taking the book value. But book value of what assets? Assets other than jewelry, artistic work, shares, securities, immobile. For these assets, we'll be taking the FMV. Remaining, other than this, all are majorly depreciable assets. Like what is left? Machinery is left, stock in trade is left. So for all this, you will take the book value. Now in this, while taking the book value, what they have said, it will be reduced by the following amounts. One is the income tax, net of refund. And second, any amount shown as asset, including unamortized amount of deferred revenue expenditure. I am sure you all understand the meaning of this. Many times on the asset side of the balance sheet, we show deferred revenue expenses. What are deferred revenue expenses? So I have done a huge advertisement campaign in the first year or the launch of this particular business that I am amortizing over a period. Or I have any other amortized expenses, like in case of goodwill or something, which I am amortizing over a period. So all these which are lying in my balance sheet as unamortized amount, I will remove it or I will ignore it. Means that will not be considered. B.
B is equal to the price which the jewelry and artistic work would fetch if sold in the open market on the basis of the valuation report obtained from a registered valuer.
Fine.
C equal to fair market value of shares and securities are determined in the manner provided in Rule 11 UA Clause 1. D is equal to value adopted or assessed or assessable by any authority of the government for the purpose of payment of stamp duty in respect of the immovable property. L is equal to book value of liabilities as appearing in the books of accounts of the undertaking or the division transferred by way of slump sale, but not including the following amounts which relates to such undertaking or division, namely,
Okay,
number
fine.
one, the pay.
Now, in assets, for other assets, we have taken book value, but for jewelry and artistic work, we take the fair market value basis the valuation report. Then for shares and securities also, we take the fair market value for which a method has been prescribed. And most important, for immobile properties, that is land and building, you have to take the stamp value. So this is how you will determine the value of different assets, A plus B plus C plus D. And from that, you will reduce the book value of liabilities. But while reducing that, certain liabilities will not be reduced. Now, this is one side. The second FMV is the FMV of what you have received by giving away your business. Please read FMV2.
FMV2 is equal to the fair market value of the consideration received or accruing as a result of transfer by way of slump sale determined in accordance with the formula E plus F plus G plus H, where E is equal to value of the monetary consideration received or accruing as a result of the transfer. F is equal to fair market value of non-monetary consideration received or accruing as a result of the transfer represented by property referred to in Rule 11 UA1 determined in the manner provided in Rule UA1 for the property covered in said subrule. G is equal to the price which the non-monetary consideration received or accruing as a result of the transfer represented by property other than immobile property which is not referred to in Rule 11 UA1 would fetch if sold in the open market on the basis of the valuation report obtained from a registered valuer in respect of the property. H is equal to value adopted or assessed or assessable by the authority of the government for the purpose of payment of stamp duty in respect of the immobile property, that is stamp duty value, in case of the non-monetary consideration received or accruing as a result of the transfer is represented by the immobile property.
Okay. So now the second FMV, that is FMV2, represents the fair market value of what you have received. Now what it will cover: first, where money is received, it will be money. Second, where something is received in non-monetary form, and for that it is in the form of shares. So for shares, the value that you take is of 11 UA. Similarly, if you have received something which is in the form of immobile property, then the stamp value has to be taken. So for all other assets, if you are receiving as a consideration any of these assets, then the fair market value or the stamp duty value of these assets is to be taken. This is FMV2. And then finally, the final full value of consideration is higher of FMV1 and FMV2. So FMV1 is of assets, liabilities given. FMV2 is whatever you have received. Correct? Then report of chartered accountant, you have to take the report of chartered accountant and it has to be given along with your tax audit report of that year. And then meaning of certain terms. So as cost of acquisition, you have to take the net worth. What is the net worth? It is the aggregate value of total assets of the undertaking as reduced by the value of liability of such undertaking as appearing in the books of accounts. Most important, any change in the value of assets on account of revaluation shall not be taken. Now this net worth is your cost of acquisition. The cost of acquisition has to be taken only on the basis of the book value. In the book value also, if there is any valuation, revaluation, what we normally do, that will be ignored. Correct? So this is about the capital gain in case of slump sale. So over here, we stop. In the next class, we will be dealing with remaining provisions, which includes computation under 50C CAD, and we go to the section 54 exemptions. Fine, students?
Yes, sir.
Yes, perfect. So that's it from my side, students. Thank you. Thank you very much. So let us meet in the next class, which will be our concluding class for this topic of capital gains. So kindly, please come read with this whole subject chapter, so that in case there are any questions left on this chapter, that I will be addressing in my immediate next class. So thank you all. Thank you very, very, very much, and good night.
Thank you. Good night to you.
Good night. Yes, Ashok ji.